All right. Hello, everybody. We are here for the FOMC meeting, and it's going to start in a second. 75 bips has been announced. That is official. That's what we're rolling with. That's what the Fed wants. They want to do 75, so we're doing 75. Market rallying. Dow was up 300 points off that news, which is kind of crazy, but you know, it is what it is. Okay, mic is good, audio is good. Cool. So we're gonna be streaming the meeting. We're gonna see what Jerome Powell has to say. Ultimately, the questions are gonna be important to see what he says. I couldn't choose, so I'm watching you and meet Kevin Love. I appreciate you, John. Yeah, I'm just gonna be streaming it. I'm gonna try popping in and out with my thoughts. But yeah, just streaming it for who. I mean, there's a million of these streams going on. I'm streaming it, and whoever wants to check it out can check it out. I was going to DCA and rally happens. We'll wait until tomorrow. Yeah, look, I don't think any of these rallies are real. I genuinely do not think these are real. We had a stock like SoFi rally up, how much percent? Freaking 18%, and then the rally kind of just ended, ASAP. I mean, like, this is a hard market to be rallying in, and I personally just don't feel like it's real. None of it's real. Now, granted, the Fed did say they are going to be looking at tightening policies or monetary policy in a much more specific way, or like a much more. They're going to have a little bit more, let's say, energy associated with thinking about these things. And as a result of that, it's a bullish signal because that means they're more likely to do 50 than 75. Like last time, it was a guarantee they're doing 75. Now it's like potential. Yeah, Sean, potential 75 from 25 next month. I don't think so. I think if inflation is bad, inflation has to be 2%. If we don't get 2% inflation, the 75 to 25 thing is not happening. It's ridiculous. Even 75 to 50 is ridiculous. So when we see the next CPI report, and I think it's next week, if 8.3 did not go down to like 7.9, which I think would be like a meaningful reduction. If it goes to 8.2, like the Fed has to, like, you have to stop inflation. That is the macroeconomic argument at the end of the day. Do we get a rug pull? It's very possible. It's happened before. I don't know if it definitely happens, but also we're not even up that much. Like, yeah, it's up, but like, what, Google was 89 this morning. Now it's 90.733. Big whoop. Like, that doesn't mean anything. Like, that's not something to be special. So I am not, I just don't think any of this is that incredibly exciting. Now I'm curious to see what Powell has to say and how the market reacts in real time to what he has to say, which is the fun part of these things. I have my second computer loaded up right here, so I'm going to be working and checking out different stuff here. But it's not what I think. It's just it just doesn't feel real, is what I'm trying to say. So I don't think we get to 10.25. Felicia, how in the hell are we going to get to 2%? Well, that's why it might take a couple of years, to be honest, because the way this market's rallying, it's we're not supposed to be rallying like this. So I don't know. I'm glad you're co-oping with Tom Nash again. Thank you so much. We just launched our first episode. Type in The Daily Cowbell on YouTube. Also, I'll pin it in a second right here. Just launched our first episode. It's super, super fun to be back with him again and exciting to speak to him and do a show with him. It's a daily show. And who knows, maybe inflation will reach 2% before like the 100th episode of our show. But we just put it out, put a lot of work into it, a lot of work into the edit. Really excited about it. I hope you all will enjoy it. Put it in the description right now. Greetings from Romania. Daniel, thank you so much for being here. Thank you all the way from Romania. That's so freaking cool that you're here. That is awesome. I'm going to share the meeting once it starts. I think it's going to start in like a couple of seconds, most likely. And then we will go from there. All right. So I'm going to be doing this from the Federal Reserve live. Yeah, man. Love Daily Cowbell. Keep it pushing. Thank you, man. Sean, means a lot. Means a lot, sir. Trying to build. I think people will hopefully come to enjoy that show. And I think it can become, I think that show can reach 50 to 100,000 people every day. I really do. I think we got a shot, but we got to work our asses off to get there. All right. Meeting is starting. Let me know if there's any problems with audio. I'll be in and out analyzing anything Jerome says, but I'm going to let him talk for the most part. Okay, there where he's coming up on the stage. All these people here, by the way, these analysts, they're all like, what was I gonna say? They're all like Yahoo Finance, Bloomberg, CNBC. They're all gonna ask a bunch of questions, and they're all like mainstream legit media. So these are very important people. They're all probably tweeting right now. It's so funny how like I'm just some random dude tweeting about the FOMC, and then you got people who work for Yahoo Finance that are also tweeting. That's what social does. It equalizes the playing field. Anyone can create and post, and it goes from there. All right, he's talking.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby. Thank you, Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and let's say the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple of things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate.
From a base of 0, that's
given
the important
persistence
part.
and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement because that really does become the important question we think now is how far to go. And I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming. And it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over tightened. I think there's very difficult to make a case that our current level is
He
too
does
tight,
not
given
think
that
we've
inflation
over
still
tightened.
runs well above.
That means he
the
thinks
federal
we've got
funds
more
rate.
to go.
So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases.
Markets are
And,
still up, even with him
we have
sounding
some ground
hawkish.
left to cover
Markets
here,
are up.
and cover it we will.
Nick Tamarosa of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking.
I know of the Taylor rule because of Tom
measure
Nash.
of
He taught me it.
inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher. I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have, a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah. So the way I would think about that is, it's a commonly for a long time thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking, what is the central bank going to do? And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing that I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this:
S&P is crashing. Well, not crashing, but it went from 386 to 382. Stocks are red. Most of the market, if you look at your portfolio, it was just green. Even if it wasn't a lot of green, it was just green. It's red. So they don't like what he's saying, which is why that rally 7 minutes ago really didn't matter.
It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive. And we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting, a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand, a lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah. So, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers. And I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits so have wages. So we look at, a very wide range of data on the labor market. So, I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages. So I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings, you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening, and maybe that's there, but it's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation.
I don't know if he actually wants wages to go up.
We think
this is the correct answer, but still,
given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings.
Basically, thinks we can get to a soft landing.
There's room for that, but
even if wages go up, it's not going to be that bad.
That'll be discovered empirically.
I don't know. His argument is wages can go up, and wages going up at a small level at the pace of inflation doesn't mean there's a wage price spiral. Obviously, a wage price spiral is really bad for inflation. Last time we had this meeting, he said he really didn't want the wage price spiral. He said he didn't want wages to go up. I mean, even said people might have to lose jobs and stuff. And so I don't know. Inflation's tricky. I feel bad for Jerome because at the end of the day, we are living in a time we have not lived in 40 years with the level of inflation we have. Like that's the period of time we're in right now. And we're trying to figure out how the heck do we deal with this? Because we cannot have decades of this type of inflation. We've got to figure it out. And the question is just how we're going to do it. Like we're not already in a recession caused by the Fed. Yeah. And they messed up on the inflation stuff, man. But the stimulus spending, the government messed up. I mean, just now we got to move forward. And I don't know what's the right path, but I do know we got to get inflation down.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the US that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend. with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and, much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but, we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully, even though it may be difficult to get it back. Getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas. And they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer term inflation expectations anchored and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Oh, no.
Hi, Chair Powell, Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust. And we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens. So there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens,
So I didn't know that. I didn't know that people in the Fed can't trade for like 45 days. That's why they're talking about why Congress is able to do it, and that's the investigation thing. But if I've interpreting correctly, and that's what he said, that's wild. They can't they can't trade for 45. I mean, it makes sense. They're in the Fed. They know stuff, right? They can manipulate stuff. So that should apply to Congress makers most likely.
I don't discuss it with the Inspector General, with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts, or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up. You also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over tighten, and we don't want to, we want to get this exactly right. But if we over tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road, and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it. You have to go back in. By then, the risk really is that it has become entrenched in people's thinking. And the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now. And I think as we're farther along, we're now focused on that, what's the level we need to get to rates. And, I don't know what we'll do when we get there, by the way. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up in, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense actually, because that for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming. Okay. But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and, that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So those I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's Demand is going to have some support from those savings and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that, you know, our job is going to require some resolve and some patience over time. We're going to have to stick with this. You know, that's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was.
Wow. The person asked, is the window for a soft landing narrowing, meaning not a really bad recession? His answer was yes. And then he added the caveat, but it's possible we could have a soft landing, but the initial answer was yes. That's, if I'm looking at Webull right now, StreamYard's got to be able to let me show two things at once. I don't know why this software does not let me show two things at once. I should be able to show. Actually, yeah. Let me stop. Oh no, this is a new computer. I don't have Webull downloaded. Okay, everything keeps missing. Anyway, I'm looking at Webull. I can at least show Google, right? Let's go to S&P 500 real quick. It's not doing as well as we would expect. So the market went up immediately when the 75 thing was announced, and then right after that, the market got hit. So there's Google, 38.13. As you can see, there we are, 38.88, 230. That's right when they reported 75. Literally, this bump right here, 3872 to 3888. That's a boom. That's a big bump there. And then we just come back down to 3814. Now we're at 379. Wow. Now we are at 379. SPY. Apple's at 147. Microsoft. Where's Microsoft? Microsoft at 224. Tesla 218. Robinhood and Roku have earnings after hours. So honestly, if I'm already live streaming, I might as well cover the earnings from Robinhood and Roku. So I'll probably just be here for a bit. But let's let the call end and then we'll talk some more. So let me get back to the call. All right, here we go. Where are we at? Boom.
It was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. You know, again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data is a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. You know, again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And you know, our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now. And it really hasn't, although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up. And I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Sorry, guys. I was on the phone with my mom. She just called me. Okay. So we're done. Well, what a market. I'm going to download Webull right now on this new computer I got. It should download pretty quickly. I got a new computer yesterday because I was getting tired of having a laptop. So I'm on a desktop right now, which is actually pretty cool. And yeah, so I mean, the market, well, it didn't do that amazing at the end of the day. That's kind of what happened. So I mean, we knew that was going to happen, right? 75 bips, that was obvious. Jerome Powell saying that wage price spirals are his biggest concern. Inflation is his biggest concern. They want to get to, what do they want to get? They want to get to 2%. It doesn't. We don't know when that thing is happening. We hope it's happening soon, but man, we have no idea. Specs on the computer. It is a i9 Intel NVIDIA. The brand is Omen. But it's pretty top of the line because I made sure not to get some slow shit because I am so tired of dealing with slow shit, bro. Like that's not, and I'm editing so many videos, like so much short form video. By the way, if you guys not following me on Instagram, at It's Amit Kukreja, a lot of I'm like a different person on social, bro. On Twitter and YouTube, I'm like the stocks guy. And then on my other YouTube channel and Instagram, I'm like this philosopher startup guy. It's like a very unique balance that I mentioned. So I edit a lot of short form videos and stuff like that. And that's what causes that. Crazy they have to lie and tell us we're not in a recession, admit it, and let's move on. Yeah, I think they're just waiting to see, is it going to be like a 2008 type of recession, which I've said this many times on my channel that I don't think that we could have a 2008 level recession because of social media and technology. I think technology is inherently deflationary, and so many things that have happened since 2008 in terms of the tech revolution we've had is difficult to imagine we would have that bad of recession. But if we do, then all the value that tech has created, all of the money and prosperity tech has created, that's going down the drain because no one's going to be willing to pay for any of that anymore. And so, you know, it's going to be interesting. All right. I'm on Webull. Let me share my screen to Webull. Let's see how the market's doing. Here we go. Now this is a brand new Webull, so I need to put it in dark mode. So let me remember where I get to dark mode. Hold on. I think we go to settings, general, theme. There we go. That's good dark. All right, we are dark. So let's go to the S&P. There we go, 378 on the S&P. As you can see, the market did not like it. We have Roku and Robinhood live at 4 p.m. So we got 30 minutes till then. I'll be here. If anyone wants to stick around, we'll be talking about the market, and we'll see that. Just got here. Are you doing a Palantir earnings live? And the comment under that. Come on, man. Obviously. Well, Scott, I'm actually no, I'm just kidding. Yeah, Palantir earnings will be live November 7th, I believe. I've done every single earnings since February live. So it's going to be exciting. I think we're going to beat pretty well. I think what we've done in the public and the governmental deals, I think Palantir is a fucking like huge opportunity. I just think that the market is absolutely not going to reward us. So I literally don't, I would like the stock price to go to $6. I mean, whatever, bro. I just care about, is the company performing? And that's it. And as long as the company's performing, that's what matters to me. And I will be buying more. and I will see you in 2030. It's that simple. It's really that simple when it comes to Palantir. I've done, and the reason I say this is not to sound arrogant. I've never researched a company to this level. I don't think I've ever researched anything other than my startup and the space my startup is in, which is in the audio discovery space. I think I know the audio market better than most people on the planet. I really do think I really do. I could have a really intelligent discussion on that. And then you have Palantir. It's like, other than those two things, I don't know what I've researched. And I researched a lot of things. I was in philosophy in high school. I did debate. So I know a lot about a lot of different things. I can speak about a lot of different things. But the things I've gone deep on are Palantir and my startup. And I'm so confident that Palantir is, I guess it's conviction. And people don't get it unless they have your conviction, which I understand. But I have my fucking conviction. I'm like, it's pretty stuck at that point. Customer retention is what I'm looking for. Yeah, and I think they're going to do well on those numbers. I think what we've seen over the past couple of deals is going to be well. I have 2,300 shares. Average is 1880. So averaging down is the goal now. Guys, good luck in your midterms. You got this, man, or end terms. Keep working. Amit, it's going to a similar SoFi scenario. Good results. Yeah, guys, SoFi was insane. Like, the SoFi earnings were actually, I got to just pull up those numbers real quick. My friend sent it to me. Shout out to Riley. The SoFi numbers were absolutely, let me show this real quick and then we'll get back into the market. Like, you don't even have to be invested in this stock to understand how stupid this is. Like, this is insane. Member growth, 61% year over year. They have now 4.7 million people that use their product, or at least have signed up for their product, right? Added 424,000 new members. Products, 7.2 million, another 69% year-over-year growth. Galileo accounts, 40% year-over-year growth, or 8% year of growth over the quarter, but 124 million new accounts have been reached via that product. Revenue, they were expected to do 390 and they ended up doing 419. So they beat it by, first of all, they beat by 51% year over year, 322% year over year growth on adjusted EBITDA, which is amazing. They're getting very close to profitability. And they beat on, what was the other thing they beat on? And they beat expectations by like 39 million. So obviously they had an amazing quarter. It's just a question of if the market's going to respect them, and the market just did not care. They cared for like 5 seconds. And I think the same will happen to Palantir, most likely. Do you still get paid if we skip ads? No, but I understand if you have to skip the ad, so it's okay. Question, will the Fed's renewed hawkishness offset potentially very positive Q4 results from Tesla? I do not think. Tesla's in a tough situation, not only because of the Fed, not only because they had a phenomenal quarter and last quarter, but and nothing, right? The market was like, nope, nothing. That's why Elon was like, we're going to be bigger than Saudi Aramco and Apple. And the market was like, nope. The market just doesn't care. So you've got that. And then you've got the Twitter stuff, which Elon's busy. And whether you like it or not, the market doesn't like that he's busy on this. So I don't think Tesla is some prime candidate to do phenomenal. Now, granted, long-term, Tesla, when we get back into the bull market, Tesla's going to be, wow, Tesla's at 215, down 5%. Tesla is down. Oh, boy. Tesla. Well, let me go to the max chart of Tesla real quick. It's like a roller coaster, right? Like, this is crazy, bro. In 2019, it was 70 cents. That's what you would be buying for. And then at the top, it was at 414. Unfreaking believable. But anyway, it's there. And then we're gone down to 225. So now we're at levels that we were at August 2021. That's the levels we're at right now. And remember, it had this run up right before, and then it came right back down. So yeah, Tesla's going to take a while, man. And it's not just Tesla, it's every stock. It's not just Tesla. Roku, 54 down 4%. ARK. By the way, guys, this computer is so quick at loading up tickers. Like, I can't wait to live stream every day from this computer. It's like so much faster. Let's go. I'm buying Tesla now. Yeah, I mean, my mom bought some more Tesla today as well. I didn't say anything, but she had her average out of 290. She got down to 240, which is fine. But my mom just really wants to be in the market. And I'm like, Mom, I don't think this is the best time to put money in the market. But I'm not really putting that much money in the market. I'm buying a little bit of Palantir here and there. But I'm really trying to stay on cash. Because there's just absolutely nothing that tells you that it is time for this market to keep going. There's just not at this moment. Soon maybe, but not at this moment. Price of Palantir. Let's go to Palantir. Palantir. Palantir, 827. Okay, so we got Palantir at 827. So it's down 5% as well. I love your mama. I love her too. I literally only buy Palantir, SoFi, and Tesla. Yeah, I mean, look, you're setting yourself up, Nate, for a strong, concentrated 3-stock portfolio for a while. Roku is such a joke. Kathy Woods will only sell when it's in the red. Yeah, I mean, the thing about Roku to me, man, is I just don't get it. I talked about it today on my morning stream, but like the idea that they're going to become some content powerhouse, which is what the CEO has said. He was like, we want to be this major content powerhouse and like compete for original content. And I'm like, bro, who the fuck watches Roku originals? Like, if anyone knows someone who watches Roku originals, let me know, because I have never, ever, ever seen that shit, bro. Roku originals, what is that? What about Fubo over? Okay, so I've heard about Fubo. Fubo, that's how you say it, right? I think Roku's better than Fubo in the fact that Roku is more of a platform for like ads, and they get a piece of the pie and all that stuff like that. So like that's why I would like that. But Fubo might be a much more smaller option because it's a small cap. Even though Roku is a little bit of a small cap as well. What's the market cap of Roku? Hold on. Last time it was like 2 billion, 3 billion or something. It is 7 billion. Oh, yeah, it's 7 billion. Last time it was 12 billion. They're doing 3 billion in revenue, so their price to sales was super cheap. But now it's 7 billion because it came down. So yeah, I mean, obviously Roku is a better play for me from a tech angle. I would definitely pick Roku over anything, but you might be invested in Origin. They create plastic that decomposes and is partnered with big companies like Tesla or Pepsi. Yeah, I've heard of them before. Palantir also kind of invested them through a SPAC. I've made a video about them a while ago. So I've heard about ORGN. They're a pretty cool company. For all the skipped ads and 1 Palantir share, shout out to Rizzy for the $10 super chat. Means the world to me. Thank you so much. Definitely helps out a lot. I appreciate it. 1 Palantir share. So I get Palantir is $8. So I'm buying that share on you. Isn't from Alex from ticker symbol U a Roku bull? Alex from ticker symbol U is not a Roku bull. I don't like the only stock I know he's like majorly bullish on is Tesla, Palantir, and Teladoc. He's a fan of Kathy. He's a fan of covering those stocks. He's a fan of like making videos that help people understand ARK Invest. But he's not a Roku like bull or a Zoom bull or a block bull. But he analyzes all the things that Kathy makes, right? And he tries to like make sense of them in a much more sophisticated way. So that's that. The Fed killed the rally. Yes, the Fed killed the rally. How many different stocks do you own? Like 5 to 6, and Palantir is like 40% of your portfolio. I'll tell you right now. I have 4 stocks. I have Palantir, Tesla, SoFi. Tesla, I only have 5 shares. SoFi is 506. SoFi is about 250 shares. Palantir is 2,300. And then I have a biotech called Purple Biotech, which I don't talk about because it's like literally the biggest YOLO play that I'll probably ever have. And in like 3 years, it might get bought out and I might make like 400 grand. But it could all go to shit as well. So Palantir is like 60% of the portfolio. Meta at 91. Yep. Meta had a 52-week low today in the morning, and now it's having a 52-week low again. Let's share the screen. Meta. Shout out to Big Ray in the chat. How much to get you to twerk on live stream? Well, everyone has a price. I just don't know if I want to name mine. That's my answer. Okay. Let me open up Meta. This is a stock that obviously we've been analyzing a lot, and it's getting to a point where I believe that I don't know if it's worth taking the risk. In the bull market, it's probably going to start rallying a little bit. The problem is what I heard in that earnings call, and I listened to the whole thing. I streamed it live. By the way, price of sales of 2.2 on Meta. Tech companies don't trade at these price to sales, man. Even Palantir is a higher price to sales than that. Market cap, though, demolished. Market cap, absolutely 242 billion. I mean, this is a $1 trillion company. $800 billion of market value destroyed in the past 6 months. I bought 10 shares of Meta at 320, sold it at 260, took my losses, put it into Carp, put it into Palantir because I was like, this is ridiculous. Look, the asymmetrical bet is that the metaverse works. The hard part is that they're going to spend so much money to get there that it might not be worth it. That is the problem. I think large caps are for 23. This year is the small cap year. It might be. It might be, Nate. Amir. Sorry, I said Amit. I meant Amir. Amir, honestly, in your opinion, how low can this go? I'm starting to worry because I'm losing my life savings. Okay, so a couple things off that comment. It can go lower. However, the bottom on the S&P was 348. We're at 379. If we get into a negative downturn, we can go lower. It can go below that 3,200 is like the major case. A lot of analysts say. However, I think that we've consolidated and formed a bottom, and now we're stuck in a pattern of what do you call that thing when you're stuck in a there's a specific market word I'm looking for, but you're stuck in a area. That's not the right word, but you're stuck in a range. You're stuck in a range and you can't move forward. So I don't think we go back to those lows at 348. And again, just because the reason I'm saying this is not because I'm guessing. My logical analysis here is that we baked in 75. CPI should come down a little bit more. We have the midterms coming up. November tends to be better. It doesn't mean we have to rally, but it also doesn't mean we have to crash per se. And the market's baked in a lot of all the bad news. So at this point, the market would just be like, oh, if we're going to go lower than 340, then we just think the world is going to end in 2023 and we just want to take over our money. If the market doesn't feel that, and there's another reason the market wouldn't want to feel that, big tech had great earnings. Like Facebook put up some amazing $27 billion in a quarter. Now, everyone hates that he's spending so much money on the metaverse, but that's a conference call issue. The numbers when they came out should not destroy Facebook. Same thing with Amazon, Google. Google put up 70 billion, Amazon 120 something billion, Apple 90 billion. Like these companies didn't do bad. So if these companies didn't do bad and, and the market's beginning to consolidate and things are baked in, we might just be stuck in a range. We might not be actually going down. But nonetheless, things could happen. Now, one of the things you did say is I'm starting to worry because I'm losing my life savings. I would heavily recommend, as just someone giving, honest advice, is you don't put all of the money you can afford to lose in the market. So if you have to sell some stuff to just have stuff on the side, then I don't want to give advice or anything to sell. There's obviously not financial advice, but like you got to have some reserve capital that you can be okay with. Granted, I'm down a lot of money as well, right? A lot of people are down a lot of money. Put it into Carp, pause. Yeah, I just noticed how that sounded. And if you're down a lot of money, which I'll be on, I'm down like almost 40 grand, right? It's a lot of money over the past year and a half. It sucks. And all of us made those decisions. The question is, do I think it's going to come back? And do I need that 40 grand right now? Do I think it's going to come back? Yes. Even if it takes 5 years, I think that 40 grand will come back and I will have hopefully much more than that because I'm DCAing slowly by slowly, right? And trying to build up bigger positions. Second of all, do I think it's going to leave or do I need that 40 grand right now? The answer is no, not for me. So I've saved up enough money and I have some other income sources where I don't need that money right now. So when it comes to life savings, I really don't think they should be putting it into the market because no matter if it goes up or down, it's just a really scary bet when you kind of need some money on the side, right? I've lost 3 to 4 years worth of gains. I'm trying to DCA as much as I can, but I'm losing the amount that I invest in a month almost every day right now. It's really hard. Yeah, if that's the case, man, your mental health is what matters more, right? It's not the fucking market. So I would take that money and like go put it in your savings instead of investing it, instead of DCAing. The money you're down and 3-4 years worth of gains, it sucks, but a lot of people are in that position and it will come back if it's in quality companies. Like my 40 grand that's lost is in a mix of Palantir and mainly Palantir to be honest, but it's not all Palantir. It's probably one other stock. One other stock is a little bit more risky. Palantir I think is less risky and I think it'll come back. And I think Palantir will come back with a vengeance when it does, even if it's in 2030. So if you don't want to lose more, just don't invest more and say for the mental sanity of it, not because of the DCAing side of it. Don't get me wrong, I own my house and have a 10,000 euro emergency fund. Yeah, and so if you have the security to not worry, then I wouldn't be stressing that deeply about the market going down, because the market will eventually come back up. It's just we don't know when. If inflation is at 8% for the next 5 years, the market's not coming back for the next 5 years. That is a fact. So we just don't know. But I wouldn't stress it if it's just about stocks going down, because stocks will come back up. You can sell covered. Yeah. And obviously there's options. You can sell premiums, or you can sell puts and collect premium. You can sell covered calls to help lower cost basis. You can do a lot of different things. When it comes to reducing stuff and getting and trading the wheel, there's a good channel called TJ Trading the Wheel Journey. I had him on my channel. He talks a lot about options and this type of stuff. And you probably even know about that stuff, Simon, given it seems like you're decent at, it seems like you've been doing this for a while with 3 to 4 years of gains. But I just wouldn't stress being down unless you need that money. And that's why I am fine when I sleep at night, because I'm like, yeah, you're down 40 grand, but what would I do with that right now? Would I, outside of invest it, right? Would I like pay for a mortgage? No. So it's like, I don't really need to worry too much about that. Thanks, Amit. I needed a pep talk. I appreciate you. Yeah, man, I appreciate you. It's nice to just be part of a community sometimes and vent. That's the cool part about building an actual community. You can just talk to people. I need to put my Discord in the description. I don't put my Discord in the description. Let me know if you guys want to be in. I'll put it in the chat. Or if anyone here is in the Discord, can you just put it in the chat? Like Nate or anybody, can you just throw it in the chat and I'll pin it. In the Discord, we have more conversations. Yeah, I view my money as a pile of garbage on fire, expected to lose half its value. Yep, pretty much. And eventually it comes back, hopefully. Would you ever own an index fund? Yeah, I mean, I'm thinking very seriously of like, so the index fund, there's nothing wrong with owning the S&P 500. It's the smartest thing you can do. The argument I present to myself is, hey, I'm 25 years old. I was 23 when I started investing. I should not be so risk adverse to not invest in stocks, because like the upside of stocks is way bigger than the upside of the S&P, and I can afford to lose it. However, the safety of having like 10% of your portfolio in the S&P, it feels really good, right? So I have not bought a single share of the S&P 500 yet, and I probably should, especially the way it's going. I think 370 is a great time to DCA and just DCAing down. If we have this crazy crash where we go to 3,200, it's like, all right, I don't think that's happening, but we'll see if that happens. I can't put the Discord in here. You just copy the invite link. Or is that me? Do I have to do that? Discord, let me share the link because I don't have the powers to do so. It says you can't invite people. Oh, okay. So I'm going to do it. I need to let you guys be able to do that. Let me do that real quick. All right, let's put that in there. Put that in there. I love losing money. That's why I invested in Audia. Big Ray. But I have to put out my October update, by the way, for Audia. It was supposed to come out yesterday, but I literally slept at 5 a.m. last night, and I launched a new show with Tom Nash called The Daily Cowbell, so I didn't get time to post it, but probably will be posted tonight. So Ray, you'll be able to see the updates on WeFunder. If anyone wants to check out the updates on my startup, because I do have a startup, wefunder.com/AUDEA. And you'll be able to see the updates on how the startup is doing. Are we able to invest in Audia? Yes. I'm going to put that link in the description right now. The minimum to invest is $100. So if you want to throw like $500 into it on a YOLO, you can. Obviously, startups are very risky. 99% chance it fails. The upside that it works, it's going to become pretty fucking big. The thing that gets me going every day is that, I've gotten to this point in my life where I have the ability to actually try to make something really fucking big. And like that already, what's so crazy, guys? All right, I want to say this real quick, and then we'll get back into the market. We got Roku and Robinhood coming up. So I followed this girl on YouTube a couple of years ago, or not like literally last year, because she made a video on Clubhouse, and I was looking for Clubhouse, right? She has like 50 subscribers or something, right? So like she's just a random girl that popped up and I subscribed to her. A year later, she now is starting her own startup. And it is so interesting because she popped up in my feed the other day and she's like, vlog, starting a startup. And it's so crazy to see that this girl I followed a year ago, I put her in one of my pitch decks, by the way, because I was making an argument about creator discovery and all this stuff when I was pitching this investor, that I followed that has 42 subscribers or whatever, talking about a topic that I really cared about, Clubhouse, which, by the way, why did she pop up? Because not that many people were making content about Clubhouse. That is the crazy nature of a search engine like YouTube. And I think if you could build that for audio, it could be really fucking big, which is There's not a lot of people talking about Clubhouse. For those that don't know, Clubhouse was like a live audio app startup, and I wanted to get more information. She made a video. She popped up even though she barely had any views. It's like supply and demand. If you're there, then you're there, and it doesn't matter how many subscribers you have. Now she's starting a startup, and I'm watching her vlogs. I came across it last night, and she's literally in the same process as me, which is like forming a C Corp and trying to get investors and trying to get funding and building an app and all this stuff. And the point I'm trying to get at here is I went the past year and a half doing all of that, like everything she's going through. I watched one of her vlogs today and it just made me so nostalgic. I was like, damn, I went through that. I went through that. I went through that. I even commented like, hey, if you need any help, like, please let me know. I know how stressful of a journey, how hard that is. Like, it's really hard. And now I'm at the point where I'm here. It's like, that was point A, all of that shit, filing in a corporation, all of that shit was point A. And now I'm at point B, and point B is really fun because point B is now trying to build this motherfucker because we got some money and some funding to, like, you know, take it to a different level. All right, we are getting a phone call. Let me answer this. I am live on stream, sir. You are on speaker.
Do you stream all fucking day? You're a gamer now?
No.
Call this guy. He's live streaming.
I realized Roku and Robinhood were doing earnings. So I was like, oh, it's only 30 minutes away. I might as well like stream until earnings. So.
You're like Matt Kors now, all day, every day.
There's 150 people here. They're excited for Roku.
It's like your 17th stream today.
Yeah, it's working. We're working.
So I just saw a funny comment on our episode 2.
Episode 2 of what, Tom? Episode 2 of what?
Of the Daily Cowbell.
The Daily Cowbell? That's a new show?
Yeah, it's a new show with you and me.
Oh my God, I didn't even know.
Yeah. It's actually, you did it twice. And clearly didn't leave an impression in you.
Oh boy. Okay, what was the comment? Because I saw a lot of funny comments too.
Somebody said this title didn't age well.
No, bro. Stocks mooned for like 5 minutes after the 75 announcement, and then it crashed.
Yeah, but it was just like a clickbait title. I mean, we actually said the opposite. We said it's going to be 75 basis points. We did get it right.
Yeah.
Also, I saw a comment. Somebody says, "I'm unsubscribing because Tom is on the show." And I was like, "See you tomorrow, my guy."
That was the funny. I was like, "This is our channel. What are you saying? What are you saying?"
No, that's a different guy.
It's a different guy.
Yeah. So one guy said, "Why is Tom on your channel? I hate him." It's like, this is our channel.
I was like, "Is this a joke or he's being serious?" I was like, "This is so funny."
Some of them might be trolling, but anyways,
a lot of the comments were good, man. A lot of people were they were excited. They were really excited about it.
I know. I just hate comments. It just amuse me. I find a lot of excitement in them. I wanted to tell you that I felt like this was one of the worst experiences watching this Fed press conference. I don't know if you had a chance to digest.
You're funny. You're a funny guy.
But watching this was like going to the dentist.
Why did you feel that way?
Because there was absolutely no information provided about the future guidance of what the Fed will do. No clarity, no sort of objective targets, metrics. He absolutely stood up there and said nothing about anything. It's the most ambiguous, let me not get into trouble, kind of, let me just survive the speech event that I've seen, even for the Fed. I mean, just show you how much in panic they are. They sent this man out there with absolutely, completely ambiguous statements. Yeah, the inflation is really, really bad. We're going to fight it super hard.
It's like he didn't say anything different for the past 7 months either.
No, but he also, he basically was saying, hey guys, we don't know what the fuck we're doing. We hope that we will somehow fall ass backwards into a solution by the grace of God. But if not, we're all fucked.
But like, do you actually expect him to have a solution other than raising rates? Like, is there any?
No, I expect more clarity when he speaks. I mean, his job as the Fed chair is to be the PR guy. He's supposed to represent to the world the policy. Obviously, he doesn't make his decisions single-handedly, but he's supposed to be the voice of the Fed. So as somebody who's watching him talk, I expect a little bit more clarity, a little bit more objective metrics. He's just not providing any sort of objective information. So he stood up there, tell me one thing he said that stuck up with you. Anything he said there that you said, oh, that's interesting. One thing.
No, the one thing he said, bro, which was different from the last conference, was he doesn't want he wants wages to go up, but in line with inflation. I was like, no, you don't. You want people to be fucking unemployed and lose their get out of here. Like, it did not seem authentic about wages because he was so adamant last time where he was like, wages need to like stop.
Dude, if that's the best thing you came up with, it just shows you how much of a nothing burger this was.
Yeah, no, this was a nothing burger. It was shorter than last time as well. It was much shorter.
Look, this is what I expected. It takes balls, what I'm about to say, but this is what I thought is going to happen. At least in my hopes. The Fed chair comes out and said, guys, we have a problem. Inflation has gotten much worse. Partially our fault. We made mistakes in tackling this issue when it just started. We missed a huge opportunity. We screwed up. We're sorry. We're doing our best. It's not really working right now. The patient isn't responding to the treatment as much as we thought. We're concerned about this. We're going to give it our best. It's going to be painful. It's going to be unpleasant, blah, 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 blah. And put out some sort of a kind of objective metric on this. Basically, hey, we expect to get to 6% by the end of next year, 4% by the end of 2025, and hit the 2% mark within 3 years or whatever, right? Give some sort of a clarity, some accountability, some transparency, some objectivity, some honesty. None of these metrics happened today. Nothing of that sort. It was a purely, let me survive this speech so nobody gets offended and say absolutely nothing people can quote me on. Speech.
No, that is very true. That is very true. He didn't say anything. And even the questions themselves, they were trying to get something out of him, and he kind of just stayed very bland around there. He did say they're he did say they are exploring a potential to not to not be as hawkish. I mean, they said it in obviously they didn't say the word hawkish. They said it in a
What
politically.
does this mean? We're exploring the potential to explore potential to explore potential to simply think about not being so hawkish. What does this actually mean, bro?
Yeah, Tom. Okay, so Tom, what level does inflation have to get to in November? I think next week it comes out for them to actually do 50. Like, what number does it have to go down from 8.3 to?
They won't do 50, bro. Unless some by miracle, like they can do 50.
So if we get to, even if we're still in 7%, you think it's not 50?
If it goes to 7%, maybe. How likely is that, though?
Yeah, it's
That's
not
like
likely.
a 1% drop. Yeah, if it's a dramatic 1% drop, then definitely there's.
Wait, so if the goal is 2% inflation, that's not going to happen for like a couple of years.
No, it's not. That's not how inflation calculation works. So when you calculate inflation, it's all referenced to the previous year. So it's the increase price level, not.
Yeah, but he wants to get to 2% inflation. That's what he's been saying.
No, let me explain. So if you have right now 8% inflation, it doesn't mean that the pace will go 8, 7, 6, 5, 4, etc., etc., etc. This is not how it's going to work. Basically, what it means that when this year is going to be over, we're going to be measuring the increase rate of prices from this year to next year. So as long as we can keep pricing stable from this point on, we can potentially hit lower inflation. You understand the idea here?
Yeah.
Inflation calculations are annual. They're annual. So the next reference, like 2023 January, is going to compare to 2022 January.
Right.
So as long as, let's say, by this time next year, we're slightly stabilized the pricing level, inflation is not going to be so bad. The problem is that once inflation is rising, it's very hard to get it to stop. That's the problem. Because usually there's an underlying cause that's pushing it up, and it's not so simple to just stop it by raising interest rates. But that's a whole different discussion. Maybe we'll do it tomorrow. On tomorrow's the Daily Cowbell.
What's that?
Well, that's a show you and I are doing actually tomorrow at 10 a.m.
Oh, wow.
After your money, your market, more money morning. I don't know.
More money, market money. Can you learn to speak, my guy?
If this stream gets to 200 likes, we'll do tomorrow the Daily Cowbell.
I don't. Well, we're gonna do it regardless. So.
Yes, of course.
Unless anyone falls asleep early. Unless two people both fall asleep on different times.
If it hits 200 likes, I'll sing a Taylor Swift song.
Okay, all right. So there's no limit though.
What's her first name? Taylor? Yeah, I got it right?
Motherfucker, you know her name. Get the fuck out of
No,
here.
I wasn't sure. I was trying to figure out if I fucked up her name or not.
Okay, the bet is if by 12 a.m. tonight I get 200 likes on this, I'm at at 56. If I get 200 likes, you have to do it.
I'll do it. I'll do like a song.
All right, 200 likes, guys. You fucking need it.
Let's get it.
All right, talk to you later.
Okay, I'm out.
All right. Okay, so Roku and Robinhood, we have 6 minutes till they report. I'm pretty sure it's right after the bell. I am very interested in seeing what is gonna happen with these two. Let's see if CNBC talked about any updates from them. I don't think Robinhood's gonna do well. I read through their Q2 earnings this morning. Roku, last time they didn't do that well, so I don't know how it's gonna happen. But we are going to see. 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 Yeah, I don't know. There's no coverage. All right, so I'm going to be doing the coverage. We are going to see. Let's check out some comments. Throw some polls out for predictions. Okay, does Roku crash worse or Robinhood? Which one goes worse after hours? Where's this thing? Okay, here we go. Start a poll. Roku, and then we got Hood. Which has a worst experience after hours? I think it's gonna be Robinhood. Robinhood is gonna get taken to the woodshed. Can you believe Robinhood, man? Like, what's their market cap right now? They went public and Kathy was buying that bitch at $38, bro. $10 billion the market cap. Okay, so 52 high was $38. No, this is not. Oh no, 50. Yeah, the 52. It was at $80 at one point. If we go to the max, yeah, $85, bro. August 31st, somehow the market let it go to 85. By the way, Palantir's down 4.9% today. Again, we're stuck in a range. We are stuck in a range. And it's not going to change. Robinhood is winning by 79% on this poll. Some of you think Roku, though. Some of you think Roku. I think Roku may not be the worst arc with the baseball after it hits a 10 bounce. Bro, imagine Roku or Robinhood shits the bed and ARK liquidates. Like, I think if you're an investor in ARK, you will absolutely just like lose your shit. Got 7 minutes. Should I get some SoFi? Quarantine Quartet, you don't got to worry about getting SoFi. You can get it whenever. You could probably get it tomorrow, get it the other day. We'll see. New business idea, allow people to buy shares in a person. I'd buy some of it. That'd be pretty cool. But the thought I was going to finish on the startup thing before Tom called is it's really cool to see someone else trying to do, their own journey. And it's difficult, man, to start from the beginning at zero. It's like she was talking about filing a C Corp, and filing a C Corp is not hard. Okay. It's harder than an LLC. But a C corporation in Delaware, which is what most startups do, it's like every big tech company is there. You have to do that if you're going to raise funding. It's hard to do if you don't know how to do it. And I know that's obvious, but you need to know the right ways to do it. And she was doing it kind of in the wrong way. She was like Googling all this random. I was like, no, that's not the way to do it, bro. It's so much more easier if you just do it this way. And, like you just go through those struggles. I've done a bunch of those things where I do things the hard way, even though it could have been done the easy way. So there's a bunch of that stuff here and there. Okay, guys, here's what I'm gonna do. I'm gonna put on a quick CNBC video. I'm gonna use the bathroom because I haven't peed in like an hour. So give me like 2 minutes. I'm gonna put some CNBC on, and then we're gonna get right into earnings. Hopefully, no one leaves. We're going to look at what are we gonna look at? We're gonna look at the bottoming process in the chip sector. So this is some AMD stuff. So let me share that real quick, and I'll be back literally in a minute. Do I use LegalZoom? No, I use Clerky. Clerky's a way better for startups. Clerky is a way better thing to register as a C Corp. All right, we'll be right back, guys, in literally a minute. And then Roku and Robinhood. Let's see what happens.
This morning, where are we broadly in terms of valuations in the chip space? Have all the headwinds been baked in?
So not all the headwinds have been baked in. We are what I would describe as going through the bottoming process. So we've had, about a quarter worth of issues with most of our companies that are particularly related to consumer PCs and handsets. And now we're seeing some of that weakness spread to things like IoT and even industrial IoT. The two areas that seem to be hanging on really well appear to be data center and cloud, and then of course automotive. So we're at a point where a lot of the chip end markets are going through some digestion of sort, but a couple of end markets are still hanging on. So I would say we're into it, and we are looking to come out of this sort of correction for most of the industries and end markets in about a quarter or two.
Okay, we'll dive into specific categories, but I want to talk about spending as well, Kumar. When we had the chip shortage, we saw those spending plans put into place, really ramp up over the last few months. We've seen some of those CapEx plans come back a little bit. Where is that in terms of the bottoming progress? Do you think that there's more cuts to come?
I do believe there are more cuts to come. So there is still a little bit of excess inventory in handsets. There is still inventory in the PC segment. And the big question mark, of course, with the rise in interest rates is whether autos will hang on or will autos correct. Autos seem to be the last strength, along with data centers. So with companies seeing what they're seeing, with companies seeing a weak consumer, I think it's very prudent that they are bringing in some of this, some of the CapEx spend.
Okay, only 7 people left. 5 people. Not bad. Not bad. Not bad. Not bad. All right, here we go. Here we go. Let's go to Webull. I'm going to report earnings as soon as they're out. I'm going to be looking at CNBC. And let's see what we've got. We've got it by the minute. It should be out soon, and we'll see it live. We do it live. The Gabe's thing. Let's see. So Dow tumbles more than 400 points. I'm drinking some ginger ale, by the way. And you're going to see what happens. All right, so... Oh, is it up? Is Robinhood up? What's going up? I saw a big green candle for a second. Hold on. Shout out to Damian Martins, bro. $20 super sticker. Man, I appreciate you, Damian, a lot. Means it a lot. Oh, yeah, the bell. By the way, the stock market is now closed. Thank you, Miyoko, for that. I got cowbelled out today. I forgot. Shout out to you, Damian. Really appreciate that, man. $20. A super chat always makes everyone's day who is a content creator. So means a lot, man. $20 is big. That's a lot of money. I appreciate that a lot. Okay, so we are still waiting for these earnings, updating CNBC, and bruh, is that a challenge? Yeah, Rizzy gave 10. You only gave 20. Rizzy, we're gonna see how much. Rizzy, you're on Twitter all day with me though, so I know you're an OG. You're on Twitter all day, but nonetheless, you were outshone today. Okay, Airbnb earnings are out. Airbnb is out. They're down 13%. QCOM down 10% already. Hold on. Let's go to Airbnb. Their fourth quarter guidance. Wow. They are down 13%. Let me share this from CNBC. Shares of Airbnb fell more than 13% Wednesday, a day after the company released third quarter earnings. So their guidance fell bad, even though earnings were yesterday. Airbnb says it expects to deliver 1.8 and 1.88 billion, below the midpoint of 1.85 billion. That's nothing. That's such a small. That's so dumb. The market's like, yeah, we don't like you. Now, Airbnb earnings were yesterday, but the fourth quarter guidance was today. That's the difference, I believe. Or at least that's what CNBC is saying. This was updated 1 minute ago. That's why I think maybe they gave guidance a day later. Maybe I'm totally wrong on this, but if it was updated a minute ago, that's why I thought. I knew earnings were definitely yesterday because I saw a bunch of tweets about it. I just thought guidance might have been. Some companies do that. They release some stuff a couple days later, but where's Roku? We don't have the numbers yet, but let's go to Roku. Let's share a screen. What do we got? All right. Where's Roku? How bad is it, man? How bad is it? Oh boy. 17%. That's not good. Oh my, Kathy. Oh fuck. Oh boy. Oh boy, hold on. I gotta tweet this. Oh my, oh my, oh my, oh my, oh my. That's not a good one. Kathy has a lot of money in that stock. Roku OMG. Roku is close to $30. Kathy was buying this at like $250. Roku OMFG. There it is. Roku's collapsed. 15%. Roku. Now, granted, Kathy sold Palantir for this bad boy. And, she also sold some Tesla. If you're going to end up buying these TV it's so funny to me also because ARK investment research analysts present themselves as like the smartest researchers in the world. And they put out all this garbage, which they present in a meaningful way about how Roku is going to go to 600 by 2026 base case and like 1200. But like, and then at the end of the day, you realize these people are not that smart as they think they are, because it's not about the stock price falling right now. It's not about the stock price. It's about, I've been screaming for a while, Roku has no moat for a long time. Now, is there a potential? Sure. TV operating system? Sure. But I don't know if this is an earnings overreaction or this actually, what is the value of this company from a content perspective? Because from a content perspective, there's not much. What was her reason for it again? Her reason for it is that there is a distributed shift from linear TV watching, which is like cable, to streaming. And Roku is the operating system, like Apple is the operating system for app stores. And they're going to take a cut of the advertising pie from all the apps that run on their app store, and they have their original content. And I was just like, how is that innovative and exciting compared to like Palantir? Like, it didn't make sense. When she sold Palantir, I said bye to Kathy. Yeah, just like I started taking her less seriously. There's some stocks that I think she got right, like Ginkgo Bioworks, I think is going to be a big one. But other than that, it's a little tough. All right, I'm trying to get the Roku numbers. Where are the Roku numbers? Why aren't the Roku? Hold on, Roku earnings. We should get the numbers ASAP. If anyone has the number, hold on. Investor relations, is this it? Oh, here it is. Read letter. Okay, we got it. Here we go. I got it. All right, I got it. Roku's here. Let me know, guys, when Robinhood is out. Let me know when Robinhood is out, because I am studying Roku. All right, let me take a big sip of my drink because I'm about to get deep into these numbers and we're about to analyze. So let me take this sip now and let's begin analyzing Roku. Okay, here we go. Total net revenue, 12% year over year. Okay, 12% year over year growth is not growth for a high growth tech company, unfortunately. That's like Google, Amazon numbers. 761 million. Platform revenue increased 15%. Gross profit down 2%. They added 2.3 million incremental active accounts to reach 65 million. Streaming hours were 21.9 billion hours, an increase of 1.1 billion from last quarter. That's not horrible. Average revenue per user, ARPU, grew to $44.25, trailing 12-month basis, up 10% year over year. Streaming hours on the Roku channel. Oh, that's a big one. That's the stat I actually care about, because my whole thing has been that the Roku channel is not, I don't know anyone who watches the Roku channel. And if you do, please let me know. But the Roku channel, 90%. Now granted, I want to know the number. If you were at like $1 and you went up to $10 and you grew your revenue by 1,000%, it's like, okay, hold on, but you're going from 1 to 10. So if they barely had any hours, I would want to know that. But okay, that's actually really encouraging to me. I think why the market dropped them just on baseline level, not understanding any of the numbers yet, is this: you can't have 12% year over year growth as a high growth tech company. This is not disruptive innovation. 12% is, if Kathy could have bought Microsoft for more than 12% year over year growth and had a way better return than buying Roku if she didn't expect that, if she expected more. Robinhood earnings are out. Okay, so we're gonna go back into Roku numbers, but let's go to Robinhood. Let's see how they're doing. The hood. How bad is it? Is it bad? 90% of what figure? Yeah, exactly. 90% of what figure? Is it bad for Robinhood? Is it bad? No, it's up a little bit. It's up. Okay, so wow, all of us got it wrong. We thought Robinhood would get shit on. Hood beat Rev and EPS. Actually decent numbers. beating rev and EPS though is not what I'm looking for. I'm looking for the client's transaction revenue. But granted, if they beat rev, then they probably did good on transaction revenues. And wow, I had a feeling Roku was going to get hit more though. But I picked Robinhood. But I had a feeling I was like, I think Roku might. LOL, admit you're crapping me up, man. On 24 hours a day now. Working, David. We working. Okay, so let's go to the Roku or the Robinhood IR, and let's read their results. What do we have? Press release, news, quarterly results. Where's Q3? There it is. Okay, here we go. Q3. Let's look at Robinhood. Let's look at Robinhood. Doge saved Robinhood. Oh boy. Here we go. Okay, let's dive into these. Net revenues increased 14% sequentially to 361. That's not bad. Transaction-based revenues, wow, they got saved. They increased. Congrats to them, man. They increased it 3%. They figured out a way to increase it. Options increased 10%. Crypto decreased. That makes sense. And equities increased. So people were still trading options and equities last quarter to the tune of $155 million to 124 plus 31 for Robinhood from payment for order flow. Net interest revenue increased 73% sequentially. Net loss was $175 million or 20 cents per share. Monthly active users decreased 1.8 million sequentially. Wow. So monthly active users last time was 14 million. 14 million, and then it decreased to 13 last quarter. That was bad. Now it's down to 12. So I'm assuming an MAU, because I run a startup as well. So an MAU is someone who just touches your startup and does something. They have to be logged in. They can't just be a random traffic visitor on a website. They have to be logged in, and they have to log in at least once. They don't have to do anything other than logged in. Boom, you're an MAU. So that means 1.8 million people last quarter said, we are not logging in to Robinhood, because if they logged in, Robinhood would count them as an MAU because they were active for the month. They don't have to be a weekly active user. They don't have to be a daily active user. But if you logged in September, you are a MAU. You are a monthly active user. So 1.8 million people did not open. These are probably people that opened up the Robinhood account, probably put like $20 into it, and then stopped caring about it. Which is why, by the way, I had 6 reasons in March that I thought Robinhood could implement to save their stock. And I want to go through them a little bit later and talk more about it. I think Robinhood can definitely turn this around, but I had some more radical ideas. Shout out to Adam Bergman. Thank you for being here. $5 super chat means the world to me. He's one of my investors in my startup. I'm going to be meeting him in 8 days at a Palantir conference that unofficially we're hosting in New York City, by the way. If you're in New York, definitely come through. Message me on Twitter for the details at MidIsInvesting. I saw, Adam, you were live streaming as well. We're both grinding. I appreciate you, man. Means a lot to me. Okay, so let's see what Vlad says. In the third quarter, we achieved our goal of reaching adjusted EBITDA profitability a quarter earlier than planned. So that's not GAAP profitability. That's operational profitability. So they're still not. Yeah, they're not GAAP profitable. They're not GAAP profitable yet. Net deposits were 2.7 billion, which annualized growth rate of 17%. Okay, so 2.7 billion were deposited into Robinhood accounts. ARPU increased to 60. Oh, this is good. So ARPU was 53 in the second quarter. Then it went up to, or the first quarter went up to 56. Now it went up to 63. So it's a $7 increase per user. That's actually really good. ARPU up being good is not bad. Cash, 6.2 billion. Not bad. Not bad on the cash. We delivered a top feature request for customers, including advanced charts, options, and cash accounts, instant withdrawals, and our self-custody Web3 wallet. In the next week, we're raising the yield on uninvested cash for Gold members, making it one of the best rates in the industry. I do pay for Robinhood Gold. I use the app at the end of the day. I love it. So $5 a month for me. So I could get 3% return on my money. I also use SoFi, but SoFi app does not compare to Robinhood's app. Unfortunately, Robinhood is just way better. On a GAAP basis, they lost 175 million. So they're still net negative 175, but adjusted positives like Palantir. Palantir, if they were profitable last year, they would have made $490 million. But obviously, stock-based compensation, all that stuff. That's why they decreased. But that's what you've got. That's what you've got. What was the other thing I was reading? Share-based compensation. Oh, this is also good. Stock-based comp decreased 33% sequentially to 110 million. Not bad, man. Dude, hit it. Who didn't do too bad? Honestly, still not great, but I thought they were going to shit the bed. Yeah. I did not think they were going to be that amazing. That's a bit wild. That's a bit wild. Okay, let's go back into Roku's numbers then. Robinhood is not bad. Let me go to Roku because we didn't get to digest those and take a little bit of a deeper look into this. I'm going to take another sip of my drink and then we're going to get into this one. Okay. We're pleased to officially welcome Charlie Collier to Roku as president, Roku Media, which is focused on ad monetization, content licensing, and production. He served as the CEO of Fox Entertainment, where he was responsible for driving the overall vision and business as he will for Roku Media. Okay, so they got someone to help them do original content. In Q3, 65 million accounts globally. I mean, that's a lot of people. It's not like it's not a lot of people. We are a leader in building innovative products that provide value, choice, blah, 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 blah. Roku OS was the #1 selling smart TV. Yeah, like all of this results in Mexico. I was talking about how they're pretty good in Latin America. All of this stuff is great, but I don't think the market cares enough. Like, it's not enough for the market to feel we're going to give you a premium. In fact, we're going to decrease you by 25%. Smart home launch included cameras, videos, doorbells, blah, 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 blah. We believe every device in the home will be smart, but it is early days. Approximately 20% of the U.S. households have cameras. We are well positioned to be the leading smart home platform, and we have strong brand affinity. Yeah, look, they're right about that. It's a question of if they're going to be able to monetize on the back end if people don't watch the actual Roku channel. I don't know who the hell watches the Roku channel. I guess people watch it. But, nonetheless, I don't get it. 21.9 billion hours in Q3 of streaming. That's good. That's something that's more. Is this ginger ale? Yes, this is ginger ale. But outside of that, TV audiences are spending longer and longer amounts of time staring at the TV screen, trying to figure out what to watch and where to find it. Of streamers we were recently surveyed, more than half say they will find new content by scrolling through recommendations from their streaming platform. And then nearly a third say they try to save recommendations by simply remembering them. That's so interesting. So their argument is that people, this is the fucking reason I think my startup can be successful. It's like their argument is that from their surveys they've done with user research, they have come to the conclusion that people are scrolling through recommendations and they're trying to find something to consume. That is similar on every single app on the planet that serves content, whether it's audio, video, articles, Twitter, whatever it is. People are scrolling, and if you show up while people are scrolling, boom, you have the potential to get discovered. Very interesting. Very interesting, Roku. So their argument is that, look, if we give people the ability to find stuff they want to see, then we have a much better shot of being valuable to people. And if we're valuable to people, because they can share, the content, or they can save the content immediately, then boom, we're good to go. Then we have them hooked. Robinhood, so it's barely up 3%, nothing crazy, but Roku collapses. Wow. Now, to be fair, this might be the best time ever to buy some Roku. Like, Arc how bad has Arc done? Arc is at 36. So Arc's not at their 52-week lows, but Roku's a bad one, man. Roku's a tough one. Honestly, though, it might be the time to buy some Roku. I'm going to tweet that right now as well. Honestly, it might be time to load up on Roku. Tweets later coming. Honestly, it might be some time to load up on Roku. What was the best thing? They had 65.6 million active eyeballs worldwide. Let's tweet it like that. It might be time to load up on some Roku. Do you guys feel it might be time to these Roku earnings are crazy? Yeah, these Roku earnings. Look, at the end of the day, maybe Roku never recovers. I don't know. I think Roku is too invested in our lives when it comes to like platforms that people use for operating systems, that when you rally, when the market gets better, you'd imagine Roku comes back. But there could be the argument that this thing never gets back to normal. What was 490? The stock was $490. goodness. It's like Upstart. It's looking like Upstart. Upstart was $401. I got to tweet that. Upstart high of 40149, now 20.43. Roku high of 91. 491. What is it now? Now 44. That's wild, man. That is freaking wild. Well, Dia, I use Roku one day. I love it. This is like the dot-com bubble. Not every stock. Yeah, that's a good point, old man edits. I don't know one person that uses Roku. So I know a lot of people that use Roku. Don't do it, admit. Don't send the tweet. I sent it. Let's see what people say. I use Roku. Well, I don't watch TV. I do not watch TV, but we have a Roku TV downstairs. But when I remember like 3 weeks ago, I had one Friday night after my Palantir live stream where I sat down and I just turned on the fucking TV. I was like, let's see what's on TV. And I turned on Roku and I was just like, what's the value? Why do people get why don't I just go to Disney Plus or Netflix from here? How does Roku monetize any of this outside of the box that you paid for? The platforms, are they paying a fee? Where's the ads for? I went on the Roku channel. I was like, what's really unique? There's just nothing unique. And so I didn't get it. You read 0 to 1 and did see the trends of tech companies which did not recover ever. Yeah, that is ultra true. Hi, Amit. What's up, Marco? Thank you for being here. It's either YouTube, Netflix, or HBO, or 90% YouTube. Yeah, man. 90% YouTube. It's tough to get off of YouTube. I mean, literally, I was watching someone who has 64 subscribers the other day. That's insane, bro. There's multi-$100 billion media companies creating content. Roku's going to spend a stupid amount of money to make the stupid original content they think people are going to care about. And then YouTube and my relationship with the platform is today I was watching someone who had 25 subscribers, 60 subscribers, 8 views on their video. I was one of those 8 people watching. That's the world I think we're going to. I don't think it's a debate anymore, which is why I'm so bullish on YouTube, but I'm also so bullish on user-generated content platforms. And that was my initial argument when Roku was at 200. I have plenty of videos on this on my channel back in February. I was like, they're not generating actual scalability with content. They're just shoving shit down people's throat or serving as a platform. And so I don't know if that's the case. I don't know if that's it. Don't forget TikTok, man. TikTok's a whole another animal. So that's the other thing. So then we got so let's look. Let me share a little bit more of Robinhood for their expectations, and see more of what Robinhood's thinking. But yeah, Robinhood did decent. Robinhood didn't do that bad. Samuel says, I'm at 168 subs, gaining around a sub every day or two at the moment. Appreciate the grind. Yeah, man, it's a grind, and you got to enjoy it and trust in the process, and just keep going at it. I'm in the same grind as you, but it's the war for attention, Sam, and the war for attention. Quite frankly, if you even get a little bit of it, it can change your life. I mean, I think 15,000 subscribers, people would say is, in the grand scheme of things, is a little bit of attention. And I raised an entire pre-seed round of funding for my startup because of that. So it matters. And the process of getting people to care about you is also what matters, because in the war for attention, you've got to truly find out how creative you can be and how consistently creative you can be. And that's the part no one talks about. People just think it's about YouTube, it's about content. No, it's about the strategy behind your content. And that takes a lot of slamming your head against the brick wall, trying to figure it the fuck out. But it's a beautiful journey at the end of the day. And so and my point is, most people don't try to fight for attention because they know they have nothing worthy of being able to get that attention, which is why anyone who shits on people for being small creators, it's like, yeah, but you're not trying. So the pursuit is everything. And that's why I'm bullish on platforms that give people the opportunity to pursue, because we're getting into an age where 50 years ago, not everyone wanted to pursue, or if they did want to pursue, they didn't have the technological capabilities to be able to pursue. Now it's possible. And the exponential opportunities from that are just gigantic. Robinhood on a GAAP basis, net loss was 175, adjusted EBITDA 147, total net revenues increased 14%. July, Robinhood gave customers the ability to trade options August, Robinhood rolled out advanced charts. These advanced charts were actually pretty decent. October, Robinhood started rolling out instant withdrawals. September, Robinhood rolled out the beta version of their wallet. I don't know how amazing that self-custody thing is going to be, but because I'm not that big into crypto, but I guess that's good for them. And looking ahead, we're excited to launch our forthcoming Robinhood retirement product. This is what I'm really looking for. I want them to give me a Roth IRA and 401k on the fucking app. I have been waiting for this. Honestly, I should have set it up by now. I haven't set it up. If Robinhood just put that on the app, I would use it like tomorrow. So I'm excited for them to hopefully do that. But amid a year inflation, why is inflation not going down? Well, we'll see. We still haven't had CPI reports, right? So we're going to see if inflation does go down. I think it's not going down in general because, well, honestly, I don't have an answer. I mean, there's oil, there's Russia, Ukraine, there's geopolitical stuff, there's a hot job economy. There's like a lot of the basic reasons, but it's the Fed hasn't been able to figure out how to handle it yet, and hopefully 75 basis points helps. Yeah, I got to start a YouTube channel. Been wanting to for a while. Yeah, Nate, whenever you want, man. You know, I'm always here to support. You can always come on my channel. Always here to help you out with anything. Love that. Been watching your entire journey. So incredible to watch. Powerful. Thanks for sharing. Thank you, Sam. Yeah, it's fun, man. You get to share your journey to the world. Whether it's 100 people, 100,000, or 10 people, the fact that anyone cares about you in a world in which everyone who's watching this knows that we don't care about anything other than ourselves and our closest family because we're so busy with all the stuff we've got going on, to give a little bit of your attention away to someone that brings some joy to your day and be the person that's actually bringing that joy or entertainment or information, whatever. It's a cool thing to try to do. And there's opportunities in it. It gives you more opportunities, and it's just a fun thing to go on that journey. All right, everybody, I'm out. This was awesome. I appreciate you guys so much. Felicia says the amount of paperwork and stress I had setting up a solo 401k is crazy. I can't imagine doing it on the app. Yeah, so if Robinhood figured out how to make that shit simple, that would be pretty cool. Or at least a Roth IRA, which I think is simpler. All right, Fed FOMC meeting done. Roku, Robinhood earnings done. Thank you all for being here. I appreciate it. I think I have another video coming out at 8 a.m., but it's just a clip from me and Sean. So if you guys already watched that podcast, you don't have to worry about it. And Daily Cowbell, if you have not subscribed to it, check it out. The Daily Cowbell on YouTube. New show with me and Tom Nash. I think it'll be fun. And episode 2 tomorrow, 10 a.m. on that channel. Thank you all. I appreciate you guys. It means the world to me. Bye-bye, everybody.